So let's get started. And please feel free to pop in questions as we go. Happy to stop. It's probably easier that way than if we advance too many slides and then came back to something. So what are the financial components of the checklist? And I think more importantly, how do they relate together? In a lot of these, I'll reference the specific rows in case it's helpful. So first chunk is revenue. Revenue basically is the number of subscribers on the network times what you might hear is ARPU, average revenue per user. And so that generates revenue. Now, I would say that's the bulk of revenue for any given ISP. Some ISPs, depending on other services that they might provide, or if they might own the middle mile part, they might have some other products that they could offer, like some backhaul to other ISPs, or from a commercial offering. And then even then, subscribers and ARPU, that will be different for retail subscribers versus business commercial subscribers. Usually your business folks are going to pay a little bit more. They're going to ask for a little bit higher quality, maybe faster service, maybe redundancy, especially if it's a big commercial user like a hospital, right? You definitely don't want your systems going offline in a setting like that. So that revenue is a big chunk of it. Operating expenses, the cost to run the network and the ISP. So it's anywhere from maintenance staff to the billing and admin team, all the way to the cars and trucks that those same technicians might use. Revenue minus operating expenses gives you your net income. And so if you ever hear things like it needs to be financially sustainable, right? Net income basically needs to be positive. It's an oversimplification, and I'll show you why in a second, but that's effectively what is deemed sustainability. Now, just because it's $0 or even $1, technically that's sustainable. But if you're working with a lot of private ISPs, privately owned ISPs, that's not going to be enough. So they're going to have their own return hurdles, target returns, where the net income needs to be a certain level over a certain amount of time for them to make the return that they need to see. Now, all of those three things together create the income statement. And so I know that is a separate line in the checklist, but these components basically create the income statement. The next chunk is the balance sheet, T189, and there are a few components to the balance sheet. First one is assets. So this would basically be things like the value of the network equipment, your accounts receivable. So basically money people owe you, but they haven't yet paid to you. That all generally goes into assets. Your cash on hand sits in here as well. The other part of that is liabilities and equity. Liabilities really being the amount you owe others. So that could be your accounts payable to other service vendors. It could be the amount of debt that you financed and need to pay off, whether that's the principal and the interest amounts of it. The third major financial statement is the cash flow statement. So there are a few definitions here. First one is cash flow from ops, and that's basically operations being the income statement. So that is the operation of the business of the ISP, but it's only the cash generated from the income statement. So if you ever hear things like depreciation, that might be an operating expense, but it doesn't impact your cash flow from operations. And so there's a strong relationship there, but even then a difference between the two. The second one is cash flow from investing. This is basically your capital expenditures. Anything you use to build the network, the cost to lay the fiber, the radio equipment, CPE, customer premise equipment can go in here. Basically anything that will help you build an asset. And so when you see capital expenditures in the checklist, the relationship is it is a use of cash in this section. Cash flow from financing, that is basically the cash you needed to spend on how you finance the business. So it could be things like interest payments, It gets quirkier, but let's just leave it there. Any interest payments or interest expenses related to your debt. And so that'll relate to your fundraising strategy. So there could be some communities that are exclusively funded by grant, and the match component might be coming from the ISP. If the ISP puts in equity, then there wouldn't be any interest costs here really. So that's cash flow from financing. That'll change for each community. That gives you your net cash. All of these statements together, the interrelationships between the different ones. So net income basically tells you how much equity you've generated in a given time period. It also is the start of cash flow from operations. As I mentioned earlier, you then take out any expenses that were that didn't impact cash, like depreciation. So that's the relationship between the three, from income statement to the others. Yeah, there's a relationship between balance sheet and the cash flow statement, which basically is any change in what's called your working capital, the amount of cash that's locked in your business to run the business. You know that money is going to come back at some point, but it's just a question of time. So an example would be accounts receivable. So if my accounts receivable goes up, that means there's more people who owe me money. And so if that goes up, that is actually considered a use of cash. I know it's coming eventually, but that means it's less cash I have at any given time to run the business. Opposite is true with something like accounts payable, where if accounts payable goes up, that is money I know I owe, but I haven't spent the cash yet. So an increase in my accounts payable is actually a source of cash because it's not cash I need to spend right now. So that relationship is captured from the balance sheet into the cash flow part of it, and really into the cash flow from operations section. And then you go through the entire cash flow statement to figure out what your net change in cash was, and then that goes back to the balance sheet to increase or decrease your cash account. That is basically accounting 101, wrapped up in 5-10 minutes. And all of those together, you might have heard the word pro forma, and it's also in the checklist. That effectively is the pro forma, the collection of these statements and how they interact with one another. Now there's one of these basically for every time period, right? And so the financial model allows somebody looking at it to see how the business is performing, whether there might be lower revenue than expected, higher expenses than expected. If accounts receivable is growing too much, which means you're not getting in, you might be like people might owe you the money, but you're not bringing it in fast enough. So you might need more cash on hand. It really helps map out that the financial trajectory, the narrative, if you will, of that company. And then the pro forma, there are a couple other checklist items around cash flow risk, audited financials, particularly on cash flow risk. What that basically means is there any risk to any of these boxes really that might impact how the network performs? Are you generating more cash or less cash than projected? Anything that touches one of these things. So fiber, the cost of fiber might go up. The cost of labor to install that fiber might go up. That's a cash flow risk that hits on the cash flow from investing, CapEx side of it. Take rate. If you're expecting 80% take rate, but then what materializes is 20 in the first year and you're staying steady at 40%. That's a lot less subscribers and therefore a lot less revenue than expected. That's cash flow risk. So cash flow risk really is anything that might impact the pro forma. What will we dig in on today? Really these four things. So a little bit more on the income statement, CapEx, fundraising strategy. I know there's a group of folks who wanted to unpack that a little bit more. And then cash flow risk. One of the things I wanted to end on was why do ISPs and investors go through the financial modeling exercise, and more importantly, what is it that they're looking for in that model to make certain decisions and determinations. So we'll go through an actual example from one of our investment analyses later.
Hey, Brian,
Yeah.
wondering if I can step in with a question from the last slide before we move on. So some of our communities are talking with multiple ISPs, and the question is, can they request this data that you were showing in the previous slide across the different ISPs? Do ISPs typically give out this type of information? Is there anything they should look for when they're comparing?
That's a really good question. So if you're RFPing out to a bunch of ISPs, it certainly can be an RFP requirement, depending on the type of relationship. Like if you want like some type of a partner to build like an open access type of thing, you might get some complaints. Know that the model that they send you will be, the assumptions will be modified conservatively, right? They're not going to show their entire hand of all the money that they're making. They might even be more pessimistic on certain assumptions like take rate, lower take rate, higher CapEx, and say, see, this is an example of where we don't meet our ROI and why we need, certain grants or, free permits or whatever it might be. So know that that is going to be part of the dance. Don't take anything on face value. I think it is reasonable to ask. At the very least, you might have a shortcut to getting a model, and then if you have better information on what you think is take rate, what you think might be expenses, etc. You have an evidence-based or at least an analytically based negotiating tool to go from. Anything else on that one, Sarah?
No, I think you covered it.
Okay. So digging into the income statement, people asking if I didn't fully answer it, please add it back with the nuances, and I can try to readdress. So revenue, what are the components of revenue? Passings and take rate form the first chunk. So the number of subscribers a network might have, it's a combo of these two things. One is passings, which is what are the number of eligible or potential subscribers you might have. Some people might call this meters. For every household that might be passed. So that's passings. The take rate part of it is the percent of those who could sign up, who actually does sign up, and that will determine the number of subscribers that you have. Again, slightly different between residential versus businesses. Then we have ARPU. There's ARPU, average revenue per user. And so one of the things you should definitely ask ISPs is, what are your service plans, right? And where ARPU comes in is, we know not everybody will sign up for the same package. So as an example, if an ISP says they have a $50 package and a $100 package, the question then becomes, what percent of folks will sign up for the $50 versus the $100? If you have 50% of the folks signing up for $50, 50% of the folks signing up for $100, your average revenue per user is $75, right? It's square in the middle. And so from a community perspective, it'll be really helpful to understand the appetite of your community and individuals in thinking which package would they go for, how much can they afford. On the flip side, knowing that kind of willingness or ability to pay from folks will help you in your negotiation with the ISP to say, $50 for a low cost package, that's not going to work here. Is there any way you could get it closer to $45, $40? Do you take the ACP as long as it's available? So the net to the $50 subscriber might be $20. So that helps you arm you with a little bit there. Operating costs, really two major types to simplify. Service provision is one. You might hear this as like cost of goods. It's basically the cost to provide the internet for which they are generating revenue. And so that could be the technicians, technical staff. It could be if a router goes down, or if a optical network terminal box goes down, right? Like we're fixing that. Corporate and overhead is the other big one, and this would be any costs that are needed to run the company, but are not directly attributable to a subscriber or to the provision of internet, providing the internet service. So this could be things like marketing. It could be the customer service element of it. Certainly, a lot of the corporate staff fall into this bucket. So who can / should do this? This will be my perspective. I think different takes on this one. As an investor, I generally do not believe or will heavily discount any financial model that is not coming from the organization that will be doing the work. And there's just something to be said of if your org is on the hook, there's generally a greater level of accuracy because you have to deliver it. And so that's what I'll really look for in thinking about who created this. At the end of the day, a lot of this are just relationships between different variables. So the real question is, how believable are the assumptions? How believable is that take rate? So that's where I think communities, non-financial modelers have a critical role to play. Network business consultants can also put this together. I think there's generally a bit more of an outside-in perspective, so there's going to be some discounting there in terms of the accuracy, but I think that can be helpful for folks to get a start with at least developing the mechanic and getting a sense of ballpark of where stuff is. So what can communities do? First one is validate a lot of the assumptions. So things like passings and meters. We're looking at one opportunity where the ISP said, oh, this is going to be the CapEx cost because we have to lay 400 miles of fiber. And the community was like, oh, wait a second. We only have like 250 miles of road. Like, there's a gap there. Well, let's figure out where that mileage is happening, making sure you're not building fiber to nowhere. So that can be incredibly valuable. Surveying residents on their ability and willingness to pay, as I mentioned earlier. And the more robust that data, the more believable it is. I think the easier it is to negotiate with an ISP of, no, this is what we think the economics really are. Therefore, we want XYZ concessions, or we definitely want you to pass in certain areas, et cetera. And the other validation here is, wait, why aren't you passing through that community? I know John and Joe over there, and they have no service. The ISP might say, well, per this map that we're using over here, it looks like they're served, right? And that hints to, just bad data, bad maps. So do you need to then do a broader challenge process, making sure folks are categorized appropriately? Let me pause there. Any questions?
So just to reiterate, Brian, who is likely doing these lines that we just spoke about on the checklist?
I would say primary ISP, whoever is delivering the service. I would say a helpful start could also be a network or business consultant. If you wanted to get armed with something but didn't know how to do it yourself.
Great. So for our grantees who are listening, likely these are the type of things you'll be asking for from ISPs. And then for grantees that are focused on digital equity, is there anything that they should be listening out for in this financial plan part of the presentation?
Are the pockets of folks that you know who do not have service, are they included in this map? So when an ISP will say, well, we're planning this amount of say 1,000 passings, but you know there are 1,500 folks in households in your community that don't have service. There's a discrepancy. Okay, let's look at the 1,000. Where are they? Versus where this other the 1,500, or where's that 500 discrepancy coming from? It would also be on the service plans. How many people might sign up? So if you have a very robust boots on the ground campaign, and you've talked to all 1,500 folks, and 1,450 of them say, I want service and I will pay X dollars for it. That is a level of robust data that the ISPs or whoever else is building the model will never be able to have. And I think it completely reframes the economic negotiation.
Great. And we have a few more questions I've received, but I think you might be getting to them in the next slide. So I'll let you continue before we get to this.
CapEx. So a couple things here. Two major types of CapEx. You might hear growth CapEx, installation CapEx upfront. It's basically all the spent on infrastructure that's needed to set the thing up. It can be equipment. It can also be labor, the labor needed to install as part of it. So that's all CapEx. It can include make-ready costs, the conduit, the fiber, the equipment. The other major type of CapEx is maintenance CapEx. So you're going to have a huge chunk of upfront, and then a smattering of maintenance throughout the life of it. And so this could be repairs, whole maintenance, and of course the labor that goes with it. Now, for communities who are looking at various technologies like wired fiber versus wireless, this is where there's usually a different dynamic between them. So fiber networks, fiber to the home, to the premise, they'll tend to have significantly higher upfront costs, but the maintenance on it is much lower. Also, if we track back to the income statement, the operating expenses to manage a fiber network is also lower relatively. Right? And so the net income on those, especially the further out you go, can be quite healthy. We've seen anywhere from 50% on the low end up to like 90% margins. Net income is technically EBITDA margins, but for our conversation, let's call it net income margins, especially in years like 7 to 10. The opposite is true for wireless. So wireless, you're going to have smaller upfront costs, but you're going to have higher maintenance costs, right? If the wind knocks one of the antennas out by a degree or two, the network's going to degrade. So smaller upfront, but bigger maintenance going forward. The same thing also on operating expenses, slightly higher operating expenses, because you'll have to send that technician out a little bit more frequently. What can who does this? Again, the ISP is my preference, because they're going to be installing it. And so even for consultants, I'll discount that depending on their background also. If they're just using averages and they've never built a network, very discounted. But even then, it's the ISP that's on the hook, and so I'll believe the efficacy of their design in translating that into actual equipment. So what can communities do? First one is providing information that'll make this process of network design faster, easier, and more insightful. So coming off that conversation of passings, it should be, oh, well, all the passings are over here. You didn't include this 500, but there's a school right here. Did you know about the school? No, you didn't know? Well, you might be able to use their rooftop, or they might have fiber coming into the school already that you could use. So it'll be easier, cheaper to bring in that 500 you missed. It could be, wait, you forgot about this is a private property on this, hill. If we talk to Bill, Bill lives on that hill. He might be willing to install like, a 30-foot pole for you to broadcast wireless out to folks, right? And so there's that level of the lack of a better used word phrase, community engagement, right? Like knowing your community, who is where, and just the nuances that only you all would know. That can be really helpful in network design. Other thing was local knowledge around like what's actually there. So the road miles was one. Another thing was one ISP was like, oh, there's 3,000 passings in this area, and the community was like, wait, how'd you get to that? Because there's only like 2,000 households and 500 businesses. They're like, oh, well, we're using this electric metering data. And when the community dug into some of the addresses of those meters, they're like empty warehouses or abandoned lots, right? And so that would have been a passing fiber passing to nowhere because nobody's there. But it just adds cost. So validation like that can be extremely helpful. The last thing would be if you're engaging a consultant or some type of technical partner, getting help validating the network design can also be helpful. So a lot of that was community data that I mentioned, but things like, what type of equipment are they using? Is it GPON versus XGS PON? If you're paying for a network, especially if the community is putting money in, you should future-proof this thing, right? Like build this for the future. And so somebody using GPON, that's cheaper, and technologically it won't last as long as something like XGS PON, which will be able to carry better speeds, better data. Another one could be fiber strand count, right? If somebody's putting in fiber, depending on how many folks are in your community and if there are municipal uses for it, but if they're only putting in 1 or 2 strands of fiber, you might as well, right? That's again lowering cost, which will impact the sustainability of the network in the future. You might as well dig once, put in the number of strand count that you'll actually need, plan for the future. It'll be way more expensive to try to add strands later, right? So some of those things might slip under the hood, under the guise of like something super technical, but have massive implications on the usefulness of the network for your community. Let me pause there.
Yeah, got some questions for you, Brian. So you mentioned the assets that a community might own. I'm going to combine 2 questions. Where can someone go within their community to find a list of the assets that their community might own? And then relatedly, what is the community offering to the ISP with those assets? Is it cheap rent? Is it no rent? Or just speak a little bit about that.
Yeah, so where you can get the data. It depends on the municipality. I think some munis are very good at creating their own maps of like, here are natural assets like hills, foliage, mountains, where certain poles, electric poles might be, stuff like that. So town hall might be a good first stop. If some of the other utility players in the area might have a version of that. So water utilities where or sanitation, where are some of
Public
the
Works.
yeah, exactly. So that electrical utilities could be helpful. For those where none of that exists, that's where it's the expensive ground game of paying to create that data. So it really just depends on the community. There was another one in there.
Yes. What if the community? How is the community leveraging those assets? Is it?
Yeah. Yeah, I would say the most important is really just the insight. Like this exists. Please incorporate this into your network design. Depending on your role, I think, free or reduced access is very helpful, especially for make-ready costs. Shorting the permitting process, expediting that would be really helpful for them to use some of those assets. But if you're like nonprofit or civil society, a little harder. You can advocate for that, but you may not be the decision maker.
Thanks.
Okay, excellent. What do we got next? Fundraising strategy. So few things in here. I'll try to just highlight some of the most important ones. Effectively, where you want to start is the landscape of what funding is available. Federal and state level is pretty good. It's kind of the universe, but not looking at everything for the sake of looking at everything. I think it'll be important and helpful to be aware of different programs. Like there's like a low-cost loan program from USDA. I've seen some ISPs get like 30, at least 10 to 30 years at like 2% or something like that. Knowing that programs like SBA, the Small Business Administration, right? They have loan programs for small business. Knowing that that's there, I think will help you engage with ISPs who say they don't have the funding. On the grant side of it, I'm sure pretty sure I've seen like in DIA and a few other digital equity nonprofits do a great job of aggregating the universe of things. So I think the big job really is just going to be a first pass screen of what you're eligible for, given what you're trying to do. I think part of that also needs to be looking into whether any of the areas you're trying to get served, have they ever received funding previously, like RDOF awards or something? If they have, has it been spent? Has it been spent well? If not, and you want that area to be part of something like your BEAD application, having won previous awards is often a disqualifier for that census block to be able to reapply for another grant program. So you may need to start putting your evidence base together for a challenge in that area. So that's and then I would say another chunk, a bucket is local regional banks. I included a link in here for bank CRA ratings. Now, CRA stands for Community Reinvestment Act, and it's basically a bank obligation to be able to provide low cost debt into the or to investment really into the areas in which they have a commercial presence. And so you can use if you get a commercial loan from them, awesome. The CRA types of loans generally are a little bit lower cost. And I have the CRA ratings here. One way to use it is to see what banks might have low or poor CRA ratings, and then bring them this broadband project that says this is a pretty decent investment, and it will also help your CRA ratings. The other one is talking to community development finance. And so I also included a link here where you can type in certain areas to find out if they're who might be a CDFI in and around the area you're trying to serve. They can also provide low-cost debt, for lack of a better phrase. Local foundations and philanthropy. And it's been interesting. I think, from what we've seen, national philanthropy is a little less familiar with this as a problem, at least the magnitude of it, or the best role that they can play. Local philanthropy, living in your communities, are very acutely aware, but the check sizes tend to be smaller. And so it's a little bit of a balance. But I think as you're thinking about an entire fundraising strategy, it'll be helpful to see which buckets you can pull from to sum it all together.
Brian, who is approaching the CDFI or the banks regarding CRA? Is it the ISP? Is it the community? Is it both? Does it depend?
I would say it depends on timing. I tend to encourage folks to reach out to investors sooner rather than later to get it on their radar screen. You can start building a relationship and start getting a sense of what is it that they need to see in projects before they were to sign off on a loan. So you can build a little bit of the finish line, what you need to get to, and then engage them often. I think it's going to be depending on who you are. The big question is going to be who's the borrower, who is actually taking on this obligation, this debt. Is it the ISP, which probably banks would prefer? Is it the municipal? If it's the municipal, what's the state of the muni's finances and balance sheet, right? Do they have too much debt? Do they have enough income to warrant having that debt? So that there are a few ways to structure around it, but it could be either. One of the things that Connect Humanity is experimenting with is to see if a community could create their own almost broadband co-op or broadband foundation as like a new entity to be the borrower. So I would say there's depending on who you're talking to and their level of creativity, appetite for risk, I think will help you narrow that in.
Great. And just a reminder to Accelerator folks who are on the call, Connect Humanity's website does have a list of resources that includes some funding information. And then ILSR has also done some research for us, and that is in the funding folder on the Google Drive. And then we can also send a follow-up email with those resources.
What do we got here? Where can the match letter of credit come from? So the match part of it isn't going to be terribly different than what we were just talking about. Letter of credit is a little bit more of a nuance, and so that one would generally need to be the ISP. And so there are letter of credit providers. I think there's kind of a small industry popping up, or at least growing into the broadband space with this need. Don't forget that NTIA has also recently expanded that a little bit to include performance bonds. And that might actually be the easier way to go, depending on the ISP and how big they are, their credit worthiness, and some of the relationships they might have. So performance bond providers, I think it's a very much a tried and true product. There will be folks that can do that. Letter credit, performance bonding, I would probably put that more on the ISP side of it. You should be aware, and this very much needs to be part of the fundraising strategy of what we have to solve for. So how? But I think they'll be able to drive that more. For something like Match, that's really open. And so Match could come in so many different ways, whether it's the municipal adding it as their contribution to, a public-private partnership. It could be 50-50 between the muni and the ISP, or it could be all the ISP providing that match. This is where having that financial model or some kind of ballpark estimate of where you might fall on the economics can be really helpful. And one of my biggest advices here is it'll be very easy to default, almost knee-jerk, to having the ISP solve for the match and letter credit performance bonding problem. One of the phrases that we have in here is capital is power. So whoever is solving that capital problem often dictates a lot more of the terms of how the network is built and how it will be run. And so keep that in the back of your mind. This is one where it's inversely related, right? Like ROI, return on investment. The more you invest in this effort of fundraising, the bigger return's going to be. The more you outsource it, the less control you'll have over some of the design and operations.
Any best practices or comments for our grantees who might have some capital or resources to put into an ISP agreement or project?
Don't tell them how much you have. And so at least at the beginning, right? So you absolutely say, we have money to bring to the table, like let's figure this thing out. And then it's the back and forth negotiation. And so some great negotiating books out there. I think the two that one is Getting More, I think by Stuart Diamond, and then the other one was that FBI negotiate, like is it Chris Voss, like that. That's effectively what you'll be, not hostage negotiation like the FBI, but that's effectively the dynamic between you and the ISP. Every card that you show is more information for them. Can you get them to show a card back so that you have information for what you might ask for? One way this could play out is if you say, oh yeah, we have a little bit of money, they come back with their passings, the thousand, back to the 1,000, 1,500 one. If that 1,000 is more concentrated in the middle to high income, and it's like, where's the 500? And it's like all in the lower income areas. The ISP could likely say, look, like we can't go over there. The economics don't work. And so you can say, well, actually, how much is that going to cost? It'll be X million dollars more. Well, it just so happens we have X million dollars in this bucket over here. So how about you pay for that and we'll pay for this? And now all 1,500 are served, as opposed to saying from the upfront, oh, we have X million dollars. Oh, well, we're going to have ISP saying, oh, we're going to have that subsidize this area because that's the only way our economics work over here. Right. So just be cognizant of what information you're releasing at what time, and what are you getting in return for some of that. Now, I know easier said than done, especially if you're depending on the position that you're in. And this is where that capital is power very much rings true.
Get to consider.
Anything else here? So tying it all together, this is really busy. Let me walk you through it. So these are actual snapshots from a financial model for one of our investments. So let me walk you through this. So once we build the model with the pro forma that you saw before, part of the question is going to be, how believable are some of these assumptions? And so if the community is saying, we think it's going to be 60% take rate and average revenue per user will be $70. ISP can come back and say, well, I call bullshit. I think it's going to be 40% take rate with $50 average revenue per user. And then you're just horse trading. The more robust your data is on survey data, maybe pre-signups, that can be helpful to substantiate a certain end of that spectrum. The other way is to just avoid that altogether. And as an investor, I'll only partially believe somebody saying, hey, my base case is X% Y dollars. What I like to do instead is to run a sensitivity analysis. And so what these outputs show is at the top here. Can you see my mouse as I move this? Okay. Yeah. Let's say the ISP says they think they're going to get 50 new residential subs per month, and they're going to get an average revenue of $40. So that basically means there's this is cash balance, by the way. So this will generate $1 million of cash balance in year 5. And so what impact does it have if they end up having 100 new subscribers per month instead of 50? What impact does that have on cash? If they generate a little bit more of average revenue per user, what impact does that have? And so this allows you to see just a range of scenarios where I can quickly see, oh, this is a decent investment, at least from a cash perspective, where I only need to get worried if they are approaching $30 in revenue per user, or getting to 100 plus subscribers per month. And now I know the metrics to monitor from an ongoing basis, but also from that point, it's like, do I have like does the evidence suggest that how likely that might end up happening? Now, for folks on the call, you might be wondering, wait, how does getting more subs decrease your cash balance? And this is it'd be because more subs means more CPE, customer premise equipment, more install costs. So this has taken a point in time where they might have had a chunk of new subscribers that just hasn't started paying yet. So that's where that dynamic is happening. Usually, from a long-term basis, it would be on the other end, right? Like insufficient subs. The bottom one is the rate of return. And so this is what both an ISP and an investor would look at to see, okay, if my minimum threshold is, say, 10%, what needs to happen for that to be the case? And so in this one, down to 10 new subs per month at $30, I'm still expected to make 17%. And this might be a tens of thousands of households size of a market. So 10 new subs per month, right? Like this is a pretty safe investment. So that's how the model is being used, and how the negotiating will happen on the back end of being armed with that model.
Okay. I do want to note that two things. That one, if you get to this, if you start seeing tables like this emerge in your planning, and you need help, with them or interpreting them or working on them, please reach out to us. We have Brian and we have a few other technical assistance providers that can help. I also want to note that if you're not doing major broadband infrastructure planning, if you're not partnering with an ISP, if you don't plan to own your own broadband infrastructure, your financial plan might look a little different from what we've discussed today. You might be making different comments and notes for your final plan. Brian, I do have a few questions that came in, but I didn't know how to loop them in. Would this be a good time to ask them? All right, so at what point when talking with an ISP do I ask for the revenue information? So the information that was listed in slide 3.
I think it's an ongoing ask. I think it'll be helpful for you to start with a sense of what you think, passings and maybe the range of take rate, if you've talked with some of your community members. But this it'll be an iterative process. So you have your understanding of it. Early on, you can ask the ISP, like, what do you think it could be? And then just triangulate back and forth as you get more data and analysis. It should just get sharper. So I would say an ongoing exercise, especially if the passings and the take rate that the ISP provides just is not consistent with what you think it should be. Differences like that absolutely should spark conversations and digging deeper into the data.
And a bit unrelated to that, do we have or know of any national or regional historical data on items such as average cost per mile or foot for buried sheath and aerial distribution?
Yeah, that should definitely exist out there. I think in some of the where could you look? You could look for any analysis that sized what the broadband need is in the country. If you look in the footnotes, like I think Vernonburg recently put out something, and if you look in their footnotes, you can see what their assumptions were. A few organizations like that. There's I'm trying to figure out if I remember these from conversations or if it was actually documented. I think that might be the most transparent set of sources. And Vernonberg's not the only one. I think I saw some like Deloitte reports, et cetera. But that should just give you an estimation. I think one of the concerns that I've had is some of these, the methodologies folks have used to size rely on previous data, which by definition excludes the unconnected communities, right? And so take some of that with a grain of salt, because every community is going to be different. Just like the saying, like if you've gone to one rural community, you've gone to one rural community. Same thing with networks, right? Like if you've estimated the cost of one network, you've just estimated the cost of one network. So take those with a grain of salt.
Okay. We also have a suggestion from Sam Shartman in the chat that you can often request the financials from federally funded projects, thinking of RDOF, Middle Mile, USDA. Thanks, Sam. This last question that I have might be a little loaded for the 2 minutes that we have left, but I'll ask it. Does net income need to be positive for community-owned networks? Is there a minimum that the net income needs to be at over what time?
That's a good question. The unsatisfactory answer is going to be it depends. So generally speaking, net income doesn't need to be positive every year. And it usually isn't. So the first few years, a network will likely be making losses as you're ramping up, because you're spending a lot to set up the network, but you're not at all the take rate that you will be, right? It usually can take years to get to that steady state take rate. That's okay. The question is going to be in the aggregate, right? And so if you're making a loss here, you will need to have offsetting income in the future. And that's actually what debt financing allows you to do, right? It'll pay for that gap now, and then you have to pay that back later. So it doesn't. Now it won't be as simple as just saying how much net income did I not have, therefore is that the financing. That's a good start to get the ballpark. But then when you layer on some of the cash needs, like CapEx actually technically isn't considered in net income, but it is a use of cash. And so the losses in the net income, you would need to bridge more than just net income losses at T0 at the beginning.
All right. Well, it looks like we are at time. Thank you so much, Brian, for distilling all that information on the finance section of the connectivity checklist. Hopefully we didn't scare anyone. And actually, I hope some communities are feeling better now, knowing that if they're going to be applying for BEAD or go after other funding, that likely the ISP will be providing a lot of the information in the finance section. So thanks again, Brian, and we'll be seeing you at our open house in 2 weeks for any lingering questions.